Big picture analysis, stock market, election year comparisons. All right, we all know it's an election year and that election years tend to be up years. Well, why is that? Well, generally it's that the FOMC is accommodative during those years. And they don't want to see the markets come apart during that time, so they tend to keep interest rates low. Of course, this is a much different time because interest rates have been at near that zero mark, and around the world, 23 countries have negative interest rates all the way for the last 8 years. So this is a very, very different time, and actually a very different election. I wanted to look and see how different 2016 might be and what the history was about election years in the second half, even though there is good consistency with the majority of election years being to the plus side. So what I did is I went back and I looked at the last 17 elections, essentially post-war elections since 1948, and wanted to make that comparison. So I think I've got something here very interesting. 17 election years that I looked at, and there's going to be some consistency there, and I think the results that you're going to see are a surprise. They actually were a surprise to me, and we're going to take a look at them. So how did I do this? Well, I pulled up profit charts and went back all the way to 1948 and actually looked for second half corrections. In other words, even though it was an up year, we're in a market right now that is up for the year and is apparently very complacent. Hardly any downticks at all, and certainly implied volatility is very low, and the market, right at this moment in maybe summer doldrums, not a lot going on, so we're kind of all being, lulled to sleep. That usually means that there's some kind of a big move coming, and, it could be to the upside or it could be to the downside. But what historically happens in election years? So let's go back. We're going to look at this chart. And what I want to pay some notice to is that, is there a correction in the second half of the year, in the election year? And, how long do those corrections last? Not so much thinking about, well, is it a decline that then the market turns around and moves up again? More right now thinking about, is it a decline that is consequential? Does it, what's a big enough decline to matter? A lot of traders would think right now a 3% drop would be pretty good, which would be some 60, 65 points in the S&P 500. I know a lot of traders that would love to see that. And then some investors, well, they might think 10% would be a lot to stomach. And could we even expect 10% to come? I mean, is that a reasonable decline to expect? So we're going to look at some things here that are very interesting. Here is a chart that we're going to go back and look quickly at 17 election years. This is the chart of the Dow Jones Industrial Average, and I have noted in here each election. Now I didn't write down the amount of correction that happened. I more wanted you to see that there was a correction in the election year and take a peek at, well, how long it lasts. So here you could see 1948. That is November of 1948 when Truman was elected. So what we're looking for is this last half correct period in here. And did a correction actually come in the election year? This actually was an election year that was, basically unchanged, maybe up a little bit for the year. That's where it closed. That's where it opened, but it was pretty choppy, right? So you can see that in this election year right over here, when Truman was elected, it actually had a decline that was some 10.5%. In today's points, that would be something like 230, 240 points in the S&P 500. So we're going to go from one election year to the next. This is 1948. You could see that right there. So we're going to go to 1952, and you can see in here, when Eisenhower was elected in November over here, you can see that actually in August, September, and part of October, there was a correction in there. It lasted about 9 or 10 weeks, but then it went up to new highs. I'm going to show you afterwards what the average, what the corrections were like in each of these years. But here you can see an up year that had a second half correction that was pretty sizable, and I'll show that to you in percentages when we get to a table I constructed. So that was 1952 Eisenhower. In 1956, when Eisenhower was reelected, you can see in here an up year, right? But note in here in this August-September period, there was a month decline that was very sizable. You can see in there that it actually came popping back, but you had a pretty good size correction in there. If I come back, that was 1952, right? 1956, actually, when Eisenhower was reelected, there was a very sizable decline in there before the election. So you can see that one came in August, September, October, and into the election time right there of a very significant decline right there. That was kind of late in a bull market. So that was 1956. We're going to jump up to 1960. And we'll bring that right over here, and you can see in here JFK elected right up over here, 1960, and you can see in here well, just this secondary correction right over here was in September, October, right in here. It lasted about 9 weeks and was actually a very sizable correction. So that was 1960. Go to 1964 right out over here, and you can see LBJ elected. Not much correction in there, right? Actually, there was almost nothing in here, a tiny one right there, and then a post-election decline right over there. Not very big, but I'm going to show you in there that that was just a tiny one right there. Didn't last very long, just 2-3 weeks right there. So that's when LBJ was elected in 64. We jump out to 68, which was a very, very wild election period, and you can see in here that it had a pretty sizable a decline or a correction early in the year right there, and then didn't really have a whole lot of a correction as we got close to the election, just 2 weeks right over there, and that was about a 5% drop in 2 weeks. In today's terms, that would be over 100 points in the S&Ps, but not much there when you look at that in 1968. 1972 we're going to look at right here, and that's when Nixon was reelected, and you can see right, whoop, did I jump past 1968, we got that one right. 1972, okay. As we had the Nixon re-election, and you can see right over here that right in this September-October period, a 10-week decline. That was actually pretty sizable coming into the election, but then a big rally then after the election right there. So closed the year very, very strong. That's 1972. 1976 is when we had the election, and that was when Carter was elected. I don't know why I think I've got it too close in here. You can't see Carter elected, but we had a decline in here in October into November of about 9 or 10 weeks that was actually quite significant. So every single election year but one that we've looked at up to this point has had a pretty sizable correction in it. And now we're going to jump up to 1980 right here when President Reagan was elected. And you could see right in here that there was a sizable correction right in here in October into November, and that was after the election right there, and that was pretty sizable. There was a modest correction comparatively right there, but that was still enough to be equivalent to some 130 or 140 points in the S&Ps in today's S&P 500. So that was 1980. We're going to jump up to 1984 when Reagan was reelected. And there was just simply a modest decline right in there. which would be surprisingly large in today's S&P numbers. I'll show you that percentage in a second. That was 84, right? Now we jump up to 1988 when Bush Sr. was elected, and you can see in here that there was a correction right in here, right into the election time, that lasted about 5 weeks, just into October and beginning of November, right over there. That's 1988. 1992, when Clinton was elected, you can see in here in August, September, October, there was a sizable correction in the market right there. Then it had a modest recovery right after that. So that had a pretty good correction into the election. Also, could jump up to 1996, Clinton's re-election. Almost no correction right there. Just 2 weeks on the downside in there, and that was about, believe it or not, 5%. I'll show you that in a second. 5%, and that came right around the election time. Just after the election, it dropped about 5%. And that was when Clinton was elected in 1996. In the year 2000, when Bush II was elected, Bush the Younger, you had a very sizable decline right over here in the market before the election. Market trying to rally right there, right? Similar to what we have now, testing up near the all-time highs, and then rolls over for a pretty big break there. So that's in the year 2000. 2004, I know this is a little tedious, but I wanted you to see all of these corrections that came in these election years. Actually, this one was in June, and then this one right over here was in September, October, about 7 weeks. That was fairly sizable right there, right into election time. And then you could see it closed strong on the year. So 2004. 2008, of course, that was when the big collapse was going on. And this was a massive decline right over here into President Obama's election. So that was part of the financial collapse right there. So that's 2008. And then 2012, President Obama's re-election, and you could see in here right into the election a pretty sizable decline right there. So those were fairly sizable declines. And then where are we right now? Well, the only decline we've had this year is into the Brexit into June, and then we have been advancing for the rest of the year. So here we are in the second half of the year without having any kind of real correction so far, and here we are in the election year. So the question is, how big were those declines? Most of them lasted something like 8 to 12 weeks. There were a few of them that were only a few weeks long, one of them only 2 weeks long. And every single one of those 17 election years had some kind of a drop. Believe it or not, in the second half of the year coming into election, all 17 election years had drops of 5.1% or greater coming into the election. We've had none of that so far this year. In fact, let me show you a table that will help you see what this looks like right here. And we're going to look at each one of those years again quickly, and you'll be able to see the month that the correction started, who was in the election, the month that it started, and how long the correction actually lasted in each of the last 17 election years. Here is that table right over here. So starting with the one we started at, Truman, 1948, a correction which began in October, as I showed you, was 10.5%, and that was, of course, into election time and through the election. You could see 52. Eisenhower, the correction begins in August, 7.1%. Eisenhower 2, August begins 12.2%. John Kennedy elected, and that was in August, a correction began 12.4%. LBJ elected, and that was 1964 in October coming into the election, a modest correction of just a few weeks of 5.1%. Richard Nixon elected 1968, a very, very hot year. George Wallace also in that election. Nixon wins. Correction starts in September of 11.6%. Richard Nixon, second election. Of course, he didn't last because he resigned after that in 1973. But look at that. As in September, a correction began, 14.7%. 76, Carter wins. In September, the correction began with 10.6%. In 1980, Ronald Reagan, 11.6% correction. It came in November. That was post-election. Ronald Reagan 2, in October, the correction started, a modest 5.8%. In 1988, George Bush, October, the correction began, 6.5%. When Bill Clinton was elected for the first time, a correction began in September of 8.8%. Clinton election 2 in December showed you only that 2-week drop, but it was 7%. So that was one that didn't really fall around the election time. That's the only one, but it still had a 7% correction in December. George Bush Jr. Elected in 2000. In August, a correction began of 15%. George Bush, the second election in 2004, a modest 5.1% correction. 2008, the big bear market, Barack Obama, 37.5% crash. And Barack Obama's second election, beginning in October, before the election, an 8.6% decline. So you can see, as I shared that with you, that as we looked at each of the charts, we saw the duration lasted generally in the order of, let's say, 7, 8, 9, 10 weeks. There were a couple that were shorter ones. Most of them began in September, October, before the election. The real minor ones were 5%. And let's forget about the financial crash, 37% when Barack Obama was elected. There were quite a number of them that were in the 11 to 14, 15% category in declines. Very fast declines moving into the election. Now, you could say, this is a year that's different. Is this a year that's different because the Fed is holding at 0% interest rate, so does that mean there won't be some kind of a decline? Is this a year because Hillary Clinton leads in the polls, and if Hillary Clinton leads in the polls, it means that Barack Obama 3 is essentially in the cards, pretty much status quo? Is this possible that the polls change and everybody gets scared of Donald Trump might be elected? There's a lot of other things that could cause a correction. And note that I have been talking about the fact that I thought that the bond market, inverse correlation to a stock market decline, would soon have a rally, and that this very well could be in alignment with that. What I've showed you is that every single one of the election years for the last 17 years has had at least a 5% decline in the last half of the year coming to the election, all actually starting August or September or October. So here we are at the end of August, so it's essentially September, October is what makes the most sense. And declines were, reasonably, 5, 6, 7%, and not excessive at 11 to 14%. That is probably shocking, right? Because nobody really expects much of a correction, especially here in election year. But I just showed you that every single one of those election years had some kind of a measurable decline. Granted, a couple of them were only 2 or 3 or 4 weeks long, but nothing less than 5.1%. So what does that mean in today's terms if the stock market were to have some kind of a significant break? Well, here's the S&P weekly chart in here. And what I essentially put in here was the corrective levels in here, and also put in what the percentages would be. So how does that work? Well, right now as I do this, the S&P 500 has made a high of the 2193.81, an intraday or interweek high right there. I've talked about resistance, in this area, and also at around 2212. So, if it was a modest year, if we're still following the trend of some kind of a decline in September, October, beginning in September, October, as in the last 17 election years, a modest 5% break right over there, which would be above the intermediate 38.2%, would be down over here, down to 2081. That would only be a 112-point break in the S&P 500. Truthfully, that's my highest objective for what I think is going to be the 18th in a row as far as some kind of a decline in an election year. If it were all 7.5%, that would take you down to 2031, which would be a 162-point decline. And if it were a 10% break, it would be down to 1974, which would be about 220 points on the downside in the S&P 500. Back over here, when we were looking for corrections, we had these in here. We thought it would be a 10 to 15% drop, and you could see it pretty much nailed that 15% number in 18 weeks. That was in the end of a big declining cycle, and we actually may get into one of those before you know it. So it would be reasonable to get some kind of a break in here of at least 110 points in the S&P 500 sometime in the next couple of months, based on everything we're looking in here. I'm not really talking about cycle analysis. I'm not really talking about anything in the background other than the fact that maybe markets do get a little bit nervous when you get into election time. And we've seen that the majority of those years have had these pretty sizable corrections. 5%, some people might say, well, big deal, they could sit through it. Of course you could. If you're an investor, that wouldn't be a big deal. And we've seen a lot of years where you've had corrections of this, 5 to 7%. Maybe 4 or 5 of them out of the last 17, and then the market roared to new highs in there. So maybe that's all it is a bit of a dip, but 100 to 150 points on the downside in the S&P 500 would not be a surprise, and for traders it would be a big deal, especially for volatilities. And as you can see, something like 150 to 200 points would be pretty normal. Based on everything we're looking at. You look at some of the elections that you would say maybe years that were a little crazy stuff going on. 1968 was a big one of those. That was Nixon and, of course, George Wallace, and that one, he beat Humphrey. That was an 11.6% decline in like 2.5 months. You look at the first year that Reagan was elected, the second year that Reagan, no, that was the first, 1980. And that one, Carter had a pretty good sized lead, and then all of a sudden Reagan came storming back, and all of a sudden the market didn't like that really, and Reagan ultimately got elected, but the market declined 11.6%. This is one of those years when things are crazy. And it wouldn't surprise me to see that 10% drop. I'm not going to call for it. I'm just going to look at what these norms are. And it looks like 5 to 7%, pretty normal. And maybe we could see something bigger. That is the big picture analysis for today. I think I made it pretty clear that, it could be a normal correction, normal decline. And 100 or 150 points in the S&P is going to feel like a pretty sizable drop, and it's going to shake some people. Let me know what you think about this analysis, and I'll see you in the next segment.